Unit 214, Portfolio Manager Operations Transparency. What are the limitations of downstream information transparency? In a perfect market, there'd be clear, instant access to everything needed to make flawless decisions. But the reality is, it's messy. Portfolio managers face several challenges to turn raw information into actionable intelligence. First issue is information asymmetry. Imagine you're at a poker table, but some players can peek at everyone's cards while you're stuck guessing. That's the market sometimes. Portfolio managers don't always have the full picture. Real-time moves by insiders or other participants stay hidden. This gap can skew decisions, leaving even the sharpest minds betting on incomplete hands. Next to think about is the lag in data, economic reports, company earnings, market movers. These events don't hit the portfolio manager's desk the second it happens. By the time a portfolio manager gets last quarter's earnings or this month's GDP figures, the world's already shifted. Acting on delayed info is like trying to catch a train that left the station 10 minutes ago. Timing's everything and delays can throw it all off. Third would be complexity, usually talked about as separating the signal from the noise. Portfolio managers are swamped with information from everywhere. Calls from traders, reading posts and event news, reviewing reports, talking to the rumor mill. It's a fire hose of information, but not all of it matters. A well-trained portfolio manager can filter out that noise to find that one clear signal worth taking action about. It's exhausting to deal with, and even the best can miss the mark when the volume's cranked up this high. And that's one of those things that drives a portfolio manager every day. A fourth issue is regulatory and compliance restrictions. Hedge funds and asset managers with assets under management have fiduciary responsibilities. Those rules are in response to regulations covering capital manager operations. If a portfolio manager is exposed to material non-public information, acting on it would bring on a compliance officer with many questions. There's insider trading laws, portfolio compliance rules, and ethical obligations to deal with. It's frustrating when you know something, but the rule book says not today. That's a real limiter on transparency's downstream flow. The last thing to address is interpretation variability. That refers to the problem where 10 managers are given the same data set and the result is 10 different interpretations. Events will happen that raise questions like, are those earnings a sign of growth or a red flag, or is that market dip a buying opportunity or a trap? Unfortunately, data doesn't come with a manual. A portfolio manager's experience will drive the formatting of data, so their own biases are used to produce results that historically have worked out well. Following information downstream isn't a straight line, and the idea of transparency becomes a murky mess of sources and methods. A system can be created for resource collection and database translations of the information. Keeping track of the actual information flow while doing it as part of a daily routine can help when considering automation opportunities. This part of the workflow is nuanced and can create roadblocks to creating a system that can produce some actionable intelligence. A good decision is difficult to make when there's confusion, whether that's by the portfolio manager or a machine operation. Unit 214, Portfolio Manager Operations Transparency.